Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So today is Monday Money Generation. So what does that mean? It's like Taco Tuesdays. You know how Tuesday is an excuse to eat tacos on Taco Tuesday? Well, we're finding an excuse every day of the week to study velocity banking. And so today will be Monday Money Generation by learning velocity banking. And today's Monday, right? All right. So let's go ahead and get started. So, what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. And so, what do you need to do velocity banking? Number one's a budget. You have income, expenses, and the more income that you make, it's probable that you'll have more debt, right? So, we have two credit cards, an auto loan, a student loan, and a $250,000 mortgage. Okay, and we need a line of credit as our main operating account. So what's a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again. That is a line of credit. So if you got credit cards, that's a line of credit. I have a home equity line of credit. So home equity lines of credits are pretty cool because they give you better rates and higher limits on them. And then I also got personal lines of credit. So in total, I have over $527,000 in lines of credit. So what does that mean? So for example, my home equity line of credit, it means I could go to the bank's website, click a button, and then with the click of a button, I can have as much as $280,000 dumped to my checking account. Right? That's all that means. Okay. And so the reason why we use our home equity or line of credit is so that we can easily dump all of our money into it and get rid of our debt. So unlike the average American who's needs a savings cushion, we're going to do the exact opposite, which is make money and then have absolutely no savings, right? And our line of credit facilitates this process of having no savings. And what happens is when we do have savings, we're going to experience a phenomenon called segregation of income. So the main difference between the average American and the velocity banker is the average American uses their checking account to pay for things, right? Whereas the velocity banker uses their line of credit. And so whenever they need an expense, they just pull out a line of credit into the checking and then they pay it, right? So that's what we're going to do. And I'm going to go ahead and copy these expenses. And so let's go ahead and do that. And then I'm going to go ahead and create something called cash flow, which is very similar to savings, except we don't have savings. How is that possible? That's interesting, right? And then once we move some debt into our line of credit, we're going to put our entire paycheck into the line of credit, take out some expenses, okay? And then after every single month, the balance of our debt is going to go down by our cash flow, okay? And as you can see right here, I practice what I preach. Beginning balance of my check account is zero, ending balance is zero, and I practice some other things. And one of the things I always focus on is having a good foundation. So here's the thing: if you got too much available credit, that's a good problem. You know what I mean? Because I have a $527,000 in lines of credit, and the whole point of getting credit is that first of all, banks don't lend money to people who need it, right? So we always need to get it before we need it. And also, it's easier to manage your cash flow when you got a lot of credit. And also, if you have an opportunity in front of you to make money, so let's say a good real estate deal, I could just go to a bank's website, click a button, bam, down payment is ready there. You know what I'm saying? Or I could just buy it all with the HELOC. Depends on my strategy, right? Okay, so let's go ahead and do the second step, which is make our line of credit as our main operating account. So we'll assume they have access to, I don't know, if we get a $200,000 line of credit. Let's say this is, we'll have access to, I don't know, 80,000. And I know what some of you are thinking, like, this is so much. Hey, you know what? It's funny. I remember a long time ago when I got like $1,000 credit card for the first time. I thought the banks were like sending me like a heavenly gift. I was like, whoa, $1,000, that's so much. And then it was funny because I was like, remember reading like, oh, you could ask for a credit limit increase. Like they'll grant you credit limit increases. I thought that was the most insane thing. And now like about every 3 months, I just ask for credit limit increases, and I got rejected 12 times. Right. So yeah, that's essentially what I do. So and it's funny is that now that I've gotten more and more credit, I used to be like, oh, $15,000 home equity line of credit, that's so much. And now that I get a $280,000 line of credit, I'm like, oh, they could have been a little bit more. Ugh. That's what happens with income too. Like you make minimum wage, and every single like increase in your minimum wage seems like a lot. But once you make $100,000 and more, it's like, well, there's someone who makes $200,000, or well, there's someone who makes $1 million, right? Or a billion if you're a millionaire. All right, so let's go ahead and assume we had a $80,000 line of credit, and let's just do this. Let's go ahead and move these two credit cards into that line of credit, right? And real talk, you're probably not going to have an empty line of credit unless you got lucky. And banks don't lend you money when you need it, right? So if you're in a situation where it's like, wow, I could really use that line of credit, they ain't going to give it to you. They ain't going to give it to you, right? It's like trying to get car insurance when you drive a car and crash it and you don't have car insurance. And then you ask, like, how do I get car insurance? I'm like, I don't know. I really don't. But if you do it right, it's much easier when you get the line of credit before you need it. Okay? All right, but let's go ahead and do this. Now, we move this $50,000 into here, and then guess what happens? This turns to 0, this turns to 0, and did I do this right? C2 minus C3, oh, this should be C8. C8, my bad. C8. Okay, so C8. Did I do this right? B8 to B13. Let me just redo this. My bad. All right. So we actually had $607 in savings. Whoa, are you kidding me? Did we really go from 607 to 2000? Whoa, we actually did. That's mind blowing. All right. And we have $50,000 of credit card debt. So let's see how long it takes us to get rid of that $50,000 credit card debt. And what we're going to do is we're going to overpay our line of credit, put the entire $6,500 as soon as it comes in, right? You can see this right here. This is what I do. Anytime I get paid, oh man, it's getting out of there. You know what I'm saying? So we're going to put our entire paycheck into the line of credit, take our expenses out, and then after every single month, it's going to go down by $2,282, right? And then we're going to go ahead and do this. And then what we're going to do is take the previous month's interest plus the previous month's balance minus our cash flow to get the next month's balance, 2282.15. All right, and so now we're going to get the average daily balance, right? Average daily balance. And then we multiply it by the interest rate and then divide by 12, right? And then we just copy and paste, and then copy and paste, and copy and paste, and then copy and paste, and then we see that in about 2 years that $50,000 is gone. Okay, $50,000, wablam, gone. Okay, all right, 24 months. 24 months. So that's, or is it 23 or 24? 24 months. 2 years. That debt is, that sucker's gone. Right, 24 months, 50K. Awesome. Awesome. All right. So now what we got to do is we take a look at our auto loan, and or actually the rest of our loans, right? And then we just got to put in 24 months to see what the current balance is. So I just put in my loan calculator here, 24, 24, 24. It gives me an updated balance, right? This is the latest balance. And take a look at this. This is what we call the cash flow index, okay? So all it is a number where that determines if you pay this loan off right now, how much cash flow do you get? That's all it means. So for example, let's see, this should be 24. For example, if I pay this off, I get $391 back. If I pay the $20,000 off, I only get $272 back. So which one's going to give me more bang for my buck? Oh, definitely this one. So let's move this to the line of credit. So I'm going to go ahead and do that, okay, to the $12,000, and then we're going to move it right here, okay? And now I'm going to go ahead and copy and paste plus 12767.89. And then now that we move that debt into that line of credit, okay, then this auto loan goes to 0. And now our cash flow has increased by $391, right? So it's now $2,673 is our cash flow. So now we just got to update it, okay? All right, so now we're going to update it. All right, so now it's going to be 2673.47, okay? And so now, 29 months. All right, cool. We got rid of the auto loan. So 29 months, right? We scroll up. scroll up, okay? So 29 months, and that's now 70K. And now let's focus on our student debt. So you know how people are freaked out about like student debt? Well, let's get rid of it, okay? So at 29 months, what's the balance of the student loan, right? So let's put it 29, 29. So it's about 19 grand. So if you know anything about the cash flow index, ideally you want to get rid of it if it's like below 50. And if there's an interest rate difference between the loan and the line of credit, you really have to consider it. But for a small amount like this, no biggie. But for something like a mortgage, that's when we really have to care. Okay. But even if we move this line of credit into the mortgage right now, we'll probably, or into the, I'm sorry, not the mortgage, the student loan into the line of credit, we probably pay like a couple $100 more than we have to. Not going to lie. Right. But it's all good. Let's just make debt pay off easy. Sometimes we pay a little bit extra just for convenience, right? Isn't it like that the point of DoorDash and all that? So let's go ahead. We move that student loan here. Okay, we move that student loan, and guess what? This goes to zero. Wablam. Okay, and now our cash flow is almost $3,000. It's almost $3,000, right? So $3,000 here, and then let's go ahead and copy and paste this, and then this is now 2945.99, and let's go ahead and copy and paste, and let's do this. And now in 3 years, we've gotten rid of the auto loan and the student loan altogether, and those two credit cards. Holy balls, right? Holy moly, holy wablam. That's what we're going to say. All right, so now it's 36 months to, for paying off the student loan, and it's going to be 94K in total. Okay, and now let's go ahead and do this, and update this to 36 months, right? How much are we paying? Or how much is left? It's going to be $233,000. Now, do we want to move this entire thing to a line of credit, especially if we're dealing with a low interest rate mortgage? Definitely not. That's like the one way. Honestly, that's like the one way that you could screw up velocity banking, moving this entire thing into a higher interest rate line of credit. The interest rate doesn't matter as long as you have enough cash flow to offset it. But in this case, there's not enough cash flow. You're paying $233,000 to only get $1,000 back in your cash flow. That's a no bueno. Okay, but here's the cool thing: we can still use a line of credit to pay it off, right? So think about this. Okay, let's say we just move a piece, we call it chunk, of the mortgage into that line of credit. How long will it take to pay it off? So, for example, if we take a look here, after 3 years, we pay how much in the principal? This is going to be like 250 minus 233. Let me just do the quick math. 250 minus 233. That's going to be 17K. Now, how long? So you can see here, it took us 36 months or 3 years to pay off 17K. What if we just move 17K of this into the line of credit? I'm not saying we're going to move 17K. We just do a small amount like our paycheck, but let's just see how long it takes. 17,000, okay? And then we just rinse and repeat. Our cash flow is the same because we haven't paid it off, right? But we see that in about okay, 6. Oh, 6. Okay, in 6 months, we were able to pay it off, and probably even a little bit more because we're still making the monthly payment. Then we were able to just following the bank schedule, right? The bank schedule generates a lot of interest, and even at 3%, not that much principal. So it took us 6 months to do something that would have normally taken us 3 years. Isn't that crazy? That's pretty crazy. Okay, so that's what we're going to do. We're going to just do what we call chunking, and ideally, the quote ideal chunk amount is just a small amount that's similar to your paycheck. And what the purpose of it is, okay, is that it allows you to focus on paying off your debt without worrying, okay, about liquidity, without actual budgeting, right? Because the budgeting could be a little bit variable. So you think about this. Why is it that when people have actual savings, they never tend to dump the entire thing into the loan, right? And that's because our society trains people that it's responsible to have a savings account when all of your money should be dumped into debt. And when you put this entire thing directly into the mortgage as an extra payment, people start to experience cash flow issues because one, their income becomes segregated, right? That's one. And number two, if you ever need your money back from a loan, then you never get it back, right? And so even if you're using credit cards and what's it called, lines of credit as a backup, that segregation has a profound chilling effect to the point where you get confused and you never do it. So why not just focus all your money in one place so you're not segregating your income? Okay, so let's go ahead and do this, right? I am going to open up my Velocity banking spreadsheet that our calculator that I always open up because it's so cool that it just tells you the payoff date, right? And so I don't have to really think about it because amortized loans get a little bit tricky, especially mortgages, because you're not only you're paying off the principal, you're also making the monthly payment. So you got to calculate that too. So give me 1 second to open it up. All right, there we go. Here's our velocity banking calculator provided by Renatus. And if I don't get lazy this year, I'm going to start recruiting more students to Renatus, right? Because this whole channel is a sales funnels for Renatus, and then eventually, along the way, I got a little bit lazy, but I need to start recruiting more students, and I probably should say recruiting more people to my so-called cult because I think people are actually more attracted to that than learning and saying that you're learning with an online educational company. I know that sounds weird, but I really feel that way. It's kind of weird. But anyways, so all I got to do is fill in the information. This is where I learned what velocity banking is from, and they actually provide this cool calculator. And then as you can see here, let me scroll up a little bit. $65,000, or I'm sorry, we put our income, expenses, our monthly mortgage payment, and why is like this going all wonky? Okay, so here's the thing that's really important. We don't have to do a huge chunk amount, right? What's most important is that we pay off the mortgage last, and the difference between the income and the expenses and our cash flow is as large as it could be, right? That's the most important thing because if I do, let's say, a $10,000 chunk, and why is this going crazy? Give me 1 second. Oh, you see that? My thing is going super crazy. Hold on. All right, so let me just do this. There we go. I think I fixed it. All right, so now here's the thing. Here's the most important thing that you're probably going to learn from this video is that you don't replace your mortgage, especially if it's a low interest rate mortgage, with the first lien home equity line of credit. So if I do this where I say, okay, I'm going to replace this with a first lien home equity line of credit. So it's this 233. Oh man, I screwed up again. So let me just do this. 233,860.4, right? Well, you might be thinking, well, I saved so much time, 6.2 years, right? And I only paid 64K of interest. Okay? So that's pretty good to me because look how much interest I saved, 43 grand. But if we just did small chunks, right? 6,500. Look at this, 5.4 years and 20K. Hmm? And the bigger the chunk, because think about it like this. I think of this as two separate ovens, right? So if you got a 3% oven, your food's not going to cook that much, right? But the problem is, okay, you're putting the food in the oven for a long time, 30 years. Now here you got an 8% oven, but you don't want to put the whole sting or shebang in that 8% of it for 30 years or however long. For you want to do as little as possible, which is why for this chunk amount, the lower it is usually, the less you pay. But you just got to do a small amount that's similar to your paycheck. So even if I do, let's say $10,000, okay, so this is 20 grand. You see how it just minimally changes things, but once you get to start to go to bigger and bigger chunk amounts, like let's say 50,000, then it goes to 27 grand, and then if I do 233,860.4, then it goes to 64 grand. Now here's a crazy thing. This is gonna be the most mind-blowing thing. Okay, you can do a $6,500 chunk and a 30% credit card, and it will beat that first lien HELOC. 26 grand beats 64K. Am I right? Am I right or am I right? So that's one of the most important things that we're going to learn is that we don't want to do a first lien HELOC unless, there's a really good reason to. And the most important lesson is we got to do the math, right? Always do the math. All right, so let me go ahead and switch screens. So let's go ahead and do that. Give me one moment. And so I'm going to not save. And we're going to go ahead and no, I forgot what. How many years was it? I think it was like 5.4. Oh well, I'll just say 5.4 because I actually exited. Oh, okay, never mind. I paused the video and then now I know it's 5.4 years. All right, cool. So now let's just do this. So 36 plus 30, so that's 3 plus 5.4, so that's 8.4 years. Debt free, right? And how much is that? That's 94,000 plus 250. So that's going to be 344K of debt were eliminated in about 8.4 years. Not bad. Not bad, right? So last time we did this, it was like 1 point something million, but that's because we had a doctor. We imagined we were doctors and lawyers, right? But good times. So today, again, like I said before, is like Taco Tuesday, but Monday. And today's Monday money generation for Velocity Banking, right? And so, how are we generating Monday? By eliminating debt, and the more debt that we eliminate, we have more cash flow. And then once we eliminate all our debt, then we're going to have what we call rich people problems. So every month you're going to have money in your savings account and you're going to be like, oh my goodness, what do I do with this money? And if you know how rich people feel about money in their savings account, it's like, well, I probably should invest it. But the hard thing is that I don't know what to invest it in. So if you have a good opportunity that will generate, let's say, 10 to 12% return, that's a lot more than, let's say, something in the bank where, even the highest yield savings account will be 4%. And then with the big banks, the average savings rate is like zero point 0.1, I think. Zero point 0.1. All right. So that's it for today. So happy Taco Monday, Tuesday, Monday Money Generation. Another excuse to do Velocity Banking. This is Korean Atlanta Mentorship, and have a good Monday.